I'm super excited to welcome Mr. Aaron Rue, Principal at RET Ventures, to give us a temperature check on venture capital right now. Aaron.
Hey guys, my name's Aaron Rue. I'm a principal at Real Estate Technology Ventures. We're an industry-backed proptech fund. Today I'll be going over through some of the high-level trends, so not product-specific, that we're seeing across the real estate technology industry, and specifically what we like to call rent tech, which is anything that touches multifamily and single-family rental operators. To give you a sense of our perspective and our view on the industry, my day job is to talk to thousands of startups, exactly like Benji's company, and really sort through what's working and what's not for our industry. There's a number of funds that are doing similar things, companies like Fifth Wall, Camber Creek, Navitas, you guys may have heard of. I think what really sets RET apart is our strategic investor base. So most venture capital funds will typically raise capital from high net worth individuals, from endowments, from institutions. We haven't raised a cent from any of those folks. All of our money comes from industry participants, companies like Heather and Bizzuto, our LPs in our fund, and we think that actually makes a big difference because we talk to them daily. We figure out, similar to all of you guys in the room, what are the operating problems that are facing the industry today, and then we go out and we find technology solutions to address those problems. Once we do that, we try to drive a lot of revenue to our portfolio companies from our LPs while they're solving problems for LPs. So I think fundamentally we think technology and prop tech adoption is in its very, very early days. The real estate industry is still surprisingly a paper and pen industry in many ways. But adoption's happening, and it's happening quickly. A lot of the public REITs, the largest operators in the NMHC top 50, are adopting technology extremely quickly. So if you're not adopting the same tools they are, you're falling behind. This is how we think about the state of the world and the tenant life cycle and the life cycle of real estate, really. So across this chart, maybe we can start on the top left, planning and acquisition. There's alternative data that a lot of folks are using to think about not just MSA level. Everyone knows where jobs are being created. People know where the hottest metro areas are. But now it's coming down to block level. People are making sophisticated decisions around, should we develop on the left side of the freeway or the right side of the freeway, all based off of alternative data. So if you're not doing that, in many ways, I think sophisticated operators are, again, getting ahead of you. On the construction side and the development side, folks are starting to use higher leverage construction methods that use new age materials. They're using new ways of scheduling teams, and construction has been one of the areas that's been hit the hardest by our inflationary environment. So this is another area of leverage that a lot of our LPs are seeing. And then finally, we get down to probably the most important part of all of our jobs, which is making sure that the tenant experience and the resident experience is great. And on the operations and asset management side, there's a whole host of things that we're seeing across how folks are listing and marketing properties, the IoT products that your tenants are using day-to-day, things like smart locks, smart temperature sensors, leak detection. And then from there, the resident engagement, creating a deeper bond to make sure that your residents don't just leave at the first chance or when there's cheaper rent somewhere else. And so across this life cycle, we're seeing a lot of action across prop tech solutions that are developing to help address some of your issues. So I think, just taking a step back and thinking about the multifamily industry, it's a bit of a unique industry in the sense that there's a high degree of fragmentation. Even the largest operators have, call it maybe 5% market share. And so this leads to some interesting dynamics. Think about consumer tech for a second. So you would never have Mark Zuckerberg sharing ideas with Elon Musk, who's going to be the CEO of Twitter, and other folks, Jack Dorsey. They don't call each other and say, what kind of CRM are you using? What data provider for the cloud services are you using? They don't share ideas because it's a zero-sum game and it's competition for eyeballs, and there's 3 or 4 players in the industry. Because our industry is so highly fragmented, folks are willing to share ideas. We see it every day among our LP base. So some of the largest operators in our industry, the Essexes, Cortlands, UDRs, Mid-Americas, Greystar, all of them are in our LP base, and they call each other, they share ideas of what's working, what's not, And that's a really unique thing that pushes collaboration and technology forward in our industry. So we've brought together this group. We have about 45 LPs today. They represent about 2.5 million institutionally managed units across multifamily primarily, but also some of the largest single-family rental operators like Progress and Invitation are LPs, home builders like Lennar and Toll Brothers. And we think in our industry specifically, when it comes to tech adoption, there's strength in numbers. If you have great technology solutions that you bring to a large base, that really helps de-risk things in two ways. One, you have more bargaining power for the startup to push their product roadmap in the direction you want them to build. Secondly, you have greater confidence they're not going to die. I'm sure a lot of folks in this industry have adopted some great product that either didn't deliver or went out of business. The prop tech industry is in many ways littered with the corpses of startups, sorry Benji, that created a beautiful product, but that never got to product market fit. And our job is to make sure that that doesn't happen with a great product, right? So we take a product like Benji's and we distribute it out to our LP base, and we make sure that there is adoption, that we coalesce the industry around a best-in-class solution. And so that's the value prop, and I think because of the way our industry is structured, it allows us to do that. So you can see here on the left, these are our portfolio companies that we've invested in, companies like SitePlan and Funnel and SmartRent, you know, companies that a lot of operators in the industry use. On the right side are our strategic investors, and over 80% of our LP base uses at least one RET portfolio company. 65% of our LP base uses 6 or more RET portfolio companies. And so this is a way that we look to drive value and revenue towards our portfolio companies while, again, improving our LP's operations. So what are we seeing in the prop tech industry today, and specifically the startups that sell to the multifamily and single-family rental industries? Over the last 4 years, we've talked to 1,700 companies that constitute 3,000 funding events. So this could be them raising a Series A, a Series B, a Series C, some sort of IPO or exit. And you can see in this chart, activity really starts to ramp up going into 2021, coming out of COVID. I think COVID was a big shock to a lot of operators in the industry. Realize we have to be less reliant on on-site staff and start to really develop technology that's implemented throughout the leasing process. You can see here, 2022 Q1, not so good. Funding's really slowed down for startups in the space. And this isn't just in prop tech, it's across the venture capital industry. And I think there's a few reasons why this is happening. The first is what we're seeing in the public markets. Massive multiple compression in growth tech names. And that's starting to trickle down into early stage tech companies. People are thinking, well, you know, if public companies trade at 10x, why am I paying 50 or 100x for an earlier stage startup? The second piece here is really around discipline and folks starting to realize that they need to be a bit more disciplined about capital on the venture capital side. And so I think over time what we're going to see is great startups with great traction, great customer lists are going to continue to raise and be able to raise at high multiples. Mediocre startups are going to go away. And that's always been the life cycle of venture capital. We forgot about that for a year or two in 2019, 2021. But we're starting to see that discipline happen again in the industry. Give you guys a bit of inside baseball on how we typically spend our days. So this is our funnel. So over the last 4 years, we've, again, tracked about 2,100, 2,200 startups. There's a lot of companies in the space of varying quality. And as we talk to our LPs, occasionally, if they're lucky, they have one person dedicated to sorting through all these technology solutions. Many don't have any, right? So folks who are doing day jobs as head of revenue management or asset management or CTOs or CIOs are having to take these inbounds. What we think of our role with our LPs is almost as an outsourced corporate development arm. So you can see here, we tracked 2,150. We get their decks, we read through. A lot of them we realize just aren't relevant, right? Or they don't have the right team, or they don't have the right technology. We take calls with about 600 of them, and then we find about a fourth of them that we think are worth introducing to our LPs. So we've mapped out our LPs' technology needs. We know, Graystar's looking at a new ERP implementation, talk to companies that are doing that in the space, and we introduce them to the right folks at Greystar. From there, we get positive feedback from Greystar, as an example. We'll do more diligence. We'll ask for financials. We'll better understand the product roadmap. We'll introduce them to more LPs and determine fit. And then from there, we've issued 29 term sheets to invest in these companies, and we've had 27 companies say yes. If you're a generalist venture capital fund, because capital in some ways has become a commodity, that ratio typically looks more like you issue 29 term sheets and you get 5 people to say yes. So I think folks in the industry, startups in the industry, understand the value prop. And then once we've made that investment, we start to drive value to them from our LP base. So that's our funnel. You can see it's pretty extreme. We talk to a lot of companies. We find very few that we like. And then when we do, we invest. So to give you a sense of going back to the top of the funnel, the activity we're tracking in the space, these are the categories that we categorize the startups we've talked to into. And you can see there's a lot of activity in a few concentrated areas. Construction tech has been really hot. Listing and marketing, folks are really thinking through how do we fight this CoStar monopoly that's happened with apartments.com. A lot of activity going on there. And then on the property management side and resident experience, that continues to be a large category as well. So getting down to some of the trends that we're keeping an eye on the RET side, the first is really around self-leasing. Self-leasing was famously adopted first by the single-family rental industry. A lot of the post-Great Financial, 2008, whatever you call it, these companies were buying big portfolios of single-family homes, disparate assets scattered across a large MSA. And they realized it's highly inefficient to show these listings in person. And so they were some of the earliest adopters in rudimentary smart lock technology, allowing folks to go see 5, 10, 15 houses in a specific MSA by themselves. The multifamily industry has been much slower to adopt this, but COVID has really pushed an acceleration here. I think the first thing that's been adopted is digital 3D touring, things like Matterport. But also, there's a lot of companies out there that are competing with Matterport, offering a similar product, almost the same, for cheaper. From there, you think about the tenant experience. Maybe they see a unit they like on a 3D tour. What they should be able to do next is go on to whatever ILS they're using and book a self-tour immediately. Doesn't matter what time, 6 a.m. on a Sunday, fine. The technology should work well enough to facilitate that. Unfortunately, today, for most of our LPs, it doesn't. Folks are still reliant on scheduling tours through email, through chat, through phone calls, and then on-site staff is still a big piece of this. Ideally, you're able to stitch your CRM, your ILS, your PMS together in a way where residents can do a self-tour at any time they want. That's just as good as a tour that's done by site staff. And for the folks in our LP group that have cracked this nut, the activity they're seeing is actually really interesting. Folks are coming in primarily early in the morning before work, late in the evening after. Sundays are the busiest day. Sundays, leasing offices are traditionally closed. And so it's really changed the behavior. It's allowed residents to see the units on their time, and the operating leverage is huge. A lot of times, folks are able to reduce their on-site staff by 25 to 50%, which is a significant amount of value creation. So self-leasing is something we're going to continue to keep an eye on. We have a number of portfolio companies, Funnel, SmartRent, Ingrain, that are all attacking this problem in different ways. And we think this is going to be table stakes in 5 to 10 years, especially in Series A multifamily. But continuing to keep an eye on as a large value driver for the industry and one that improves the tenant experience. The second trend we're tracking very closely is around smart construction and new construction methods. I think everyone in the industry has been burned in some ways by Katerra. But there's a lot of really interesting innovation happening here. I don't think we now believe that robots are going to be building our multifamily buildings in the next decade. That dream is probably dead. But there's a lot of new construction methods around materials such as mass timber that are really starting to change the way buildings are created. We have a portfolio company called Juno that actually has their first multifamily building up in Austin, completely made of mass timber, 8 floors high, and with significantly reduced construction costs versus traditional construction methods. We're also seeing innovations around scheduling, around construction management and software. And then on the retrofit side, which is really interesting, we recently looked at a company, we actually ended up passing on an investment, but a company called Spurred that ingests ILS photos and property photos and is able to take unit type specific measures and deliver them to you with about 98% accuracy. So value add investors, Cortland, one of our LPs, can actually avoid doing a large walkthrough with 30 or 40 site staff. They're able to get measurements ahead of time. They're able to send that to contractors and get level pricing and bids without ever having walked the property. And so that's helped accelerate time to market for a lot of value add folks who are doing renovations. And I think as AI and computer vision continue to get better, it's going to decrease the workload that's necessary to prep for projects before they start. Last thing I'll talk about is around the single family rental side. I assume most folks in the room are multifamily oriented, but what we're actually seeing, so Invitation and Progress are two large single family rental operators. They're both LPs in our fund. And frankly, we've gotten a lot of leverage from connecting them for multifamily operators because they solve a lot of gnarly problems over the years with their disparate portfolios. The operational complexity of running an SFR portfolio is extremely high. And as a result, they often have to rely on technology years before multifamily does. Things like maintenance, complete disaster for them because they have houses that have different SKUs, different appliances all over a specific MSA. Easy-ish for multifamily operators, right? You've got all of the same SKU. You've got a couple on-site maintenance folks. It's less of a headache. So what we're seeing is actually they're typically the first adopters of technology, and then a lot of that trickles into multifamily. On the SFR side, though, it's interesting to see the flow of capital in. So SFR is the hot new asset class. There's a ton of money that's been flowing in from financial institutions, from insurers. Everyone wants to buy single-family homes. And so as we've been thinking about this, one of the interesting things we realized is Progress and Invitation, again, very large operators, number 1 and 2 in the US, they add about 4,000 or 5,000 homes a year. They're at, call it 80, 85,000 homes. Most of the money that's being raised is not going to Progress or Invitation. It's going to what we call middle market funds, funds that are managing between 5,000 to 15,000 homes. A lot of them are newly formed, and they don't really have a great idea on how are we going to acquire these homes, how are we going to renovate them at scale, and how are we going to provide maintenance and fill these homes. So we've been thinking a lot about the picks and shovels to sell to the industry. We actually just closed a really interesting investment into a company called Picket Homes that provides essentially a fund in a box. Say you raise $200 million for SFR. They help you acquire homes that fit your buy box. They help renovate them, and then they help manage them on the back end. So I think we continue to see a lot of institutional capital flow into SFR, and we're thinking about how do we find the technologies that enable them to institutionalize the asset class in a similar way to multifamily. Continuing the trends. So a big trend for our LPs is around ESG. A lot of our big anchor investors are public REITs, face a lot of pressure from their shareholders on a quarterly basis to report on ESG. Across the industry, even if you don't answer to public shareholders, you are answering to private institutions that continue to ask for more on the reporting side, and what are we doing to help our Earth? Because of that, we put together a working group of about 20 of our LPs over the last year. They've met 12 times to talk about what are the biggest levers where we can push the industry, not just on the environmental side, but also on the S&G piece, and find the best startups to address these problems. The first trend I'll talk about, I'm going to skip the middle one over here. It's a little boring, but the left and right side of the slide are interesting. So one of the big pushes among our LPs is around in-unit energy monitoring. So there's a continued push by sources of capital to understand whole building energy consumption, but not just whole building energy consumption. They want to know down to the unit level what's going on in these buildings. For reporting purposes, for boards like GRESB, it's become an increasing area of focus. With data and understanding unit level usage, operators are then able to on communication and behavior modification that allows residents to reduce their energy usage over time, and that's become a big area of focus for some of our LPs. On the right side is a topic that's been especially interesting for us, which is electric vehicle charging. So EVs, I think we all have seen the data. They're going to be somewhere in the ballpark of a small to vast majority of our cars that are on the road in the next 20 years. The companies that have raised the most capital in this space and are attracting the most investor interest are what we call L2 chargers. These are chargers that charge relatively fast, so 3 to 4 hours to a full charge, but they're expensive. And so we started the analysis of what should we put into our multifamily LP properties with the idea that these were the right chargers. What we found as we've done more work is it's a pain in the ass to have, let's say 5 to 10 L2 chargers in your property, because you might have 15 cars. And so what happens is if it takes 3 hours to fill up, you get home at 5, you've got to incentivize the resident to move off their couch while they're watching Netflix at 8 or 9 p.m. and move their car so someone else can come down and put their car in that slot. Nobody wants to do that. It's extremely expensive. The infrastructure is high. I'm sure someone after this will tell me I'm wrong. But what we found is L1 chargers are the better solution. And that's not where we started. L1 chargers charge slowly. They'll get 40, 50 miles maybe if you're lucky overnight if you plug it in. But most folks aren't driving more than that on their commute. And you can put in 100 L1 chargers across your parking infrastructure without putting in new electrical, without wiring new electrical. It's really cheap to do. It's not sexy. There aren't that many tax credits that are targeted at L1 chargers, but it's an interesting insight that we've drawn out from our LP group over the last 3 to 6 months as we've been talking to all the startups in the space. So I think that's our house point of view there. We're continuing to work on the ESG front, and it's a big area of focus for us, for the industry, I'm sure, for our investors. And so those are sort of the 5 or 6 trends we're seeing in the industry. If you guys have any questions, feel free to shoot me a note. I'm Aaron, Aaron, at ret.vc. If you guys are a multifamily or single family operator or startup, happy to chat. Thanks for the time.